Hello, my name is Pascal Adalessossi. I'm a PhD researcher in business administration with concentration finance. In my previous video, I have presented the investment management process. So quickly, I want to summarize what I have said before. We say that the investment process management is divided in 5 steps. The first step is to setting the investment goal. The second step is to establishing an investment policy, and the third step is to select an strategy, and fourth step is to selecting a specific asset. And the final step is to measure and evaluate the investment performance. So for in our first video, we have presented the first step. Today I'm going to present the second step, which is to establishing the investment policy. This step begin by the decision allocation or the asset allocation decision. The investor or the manager has to know which kind of asset he have to allocate in view to maximize the investment. So the funds to be invested have to be distributed in the major assets. What are major assets? The classification of a major asset can be divided in 3 or 4 parts. We can say for the first class, the common stock. The second, you can say the bonds. The third, we can say cash equivalents. And the fourth, we can say real estate. What do we call cash equivalent? Cash equivalents are short-term debt obligations that have a little price volatility when we want to compare it with common stock or bonds. So common stock can be classified into 4 groups according to the type of country or the greatness of the stock exchange. So we can say larger capitalization stock, medium capitalization stock, and small capitalization stock. Concerning bonds, bonds is classified in 2 big major. We can mention government bonds and the corporate bonds. You know, corporate bonds are very, very risky. And the corporate bonds, it depends on it depends on the issuer, the type of issuer. So for this thing, For the issuer of the bonds, those companies can be classified in four major groups. We have public utility, we have transportation, we have bank and the finance, and we have a industrials. So for the first third group, their subgroup are very homogeneous. So concerning public utilities, we can say electric plants companies and gas distribution companies, water distribution companies, and communication companies. Concerning transportation, you can have airlines, railroads, and a trucking company. Concerning bank, money center banks and regional banks, saving brokerage companies, insurance companies, and finance companies. The fourth group is industrial. It is very, very heterogeneous. So the company that can be mentioned from this group are manufacturers companies, miners companies, and energy companies. So the corporate bonds are very, very risky, but there are some international private company which used to rate those companies according to the likelihoods of their defaults. So those rating companies are three. So the first is Moody's. The second is Standard and Poor. The third is Fish. That is the thing we can say about this thing. But there are some things very particular concerning this third step. I mean, when the investor decided to establish a policy of investment, there are some factors which should not be minimized. Those factors or constraints are, for example, individual or investor constraints. There are also the regulatory constraints. Then also the issue of tax and accounting. So in sum, that's why I can say about the third part of investment process management. In my third video, I will present the third step. Thank you very much. See you.